Hey guys, this is Terry with Futures.io. It is my pleasure to welcome Gomi from Gomi Indicators for today's webinar, Understanding and Exploring Delta and Order Flow. During the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. You can follow us on Facebook, YouTube, and Twitter with @Futures.io. Without further delay, I'll hand it over to Gomi. All right, Gomi, you should get the pop-up to share your screen.
Okay, let me check if everything is working.
All right, I see the first slide of your presentation.
Okay, is it okay? Okay, looks good.
Yep, looks good.
Okay, perfect. So let me manage the stuff here. Okay, so hi everybody. I would like to take this opportunity to thank Terry and Mike for hosting this webinar. And so thank you a lot, guys. I will start by a couple of words about me. So I've been a member of Futures.io since 2009, and I published on the Big Mics a lot of tools that are based on the GUM recorder that got 8,000 downloads. So just to refresh a little the context, I had to develop these tools in 2009 because I got very interested in all that was based on the Delta stuff, because I was reading a lot about it on Elite Trader, for instance. That were a lot of threads that were running on it. And there was absolutely no tool that were available on NT7 for do this, because on NT7, there's no way to record the bid-ask data, so you can only have the last prices, but there is no way that you could have any kind of a delta analysis. So that's why I wrote this this GUM framework that I published on Big Mike, to be able to first of all study the delta with the GUM CD indicator, and then after that I published the GUM volume ladder, which was a sort of a basic order flow indicator, and the GUM MP, which was a profiling indicator. So both of these indicators, they got lots of downloads, and they were forked by other developers. So the volume ladder, it became the Metro ladder, and the GUM MP, it also was forked by developers on Big Mike, and became the Alto GUM MP, which is the same kind of profile, but with enhanced settings. So I was awarded multiple gold, silver, and bronze awards on Futures.io. So I would like to also take this opportunity to thank everybody, because it's always I'm very grateful, because it's always nice to have all these kind words when you publish these tools. So it kept me going along to publish all the toolings. Okay, so now I'm an owner of the Gomicators website, and I'm selling NinjaTrader 7, NinjaTrader 8, and Sierra Chart versions of the volume ladder and the profile. So I'd like to add that I live near Paris in France, so I'm sorry for my English. We're not very good at foreign languages here. And also that I trade the DAX on CFDs in the mornings. So in this presentation, the indicators that will be used are the GUM Order Flow Pro from Gomicators for all the order flow showing, and the Delta V3 indicator from Sim22. I'd like to thank him, because he has done a very good job, and it's available for download on the Futures.io. So it's the NT8 version of the of what existed as the GUM CD on NinjaTrader 7. So I'd like to remind you that the indicators, it's free for trial on the Gomicators website for 20 days, and you can get 15 more days by subscribing to the newsletter. So to make it run, you just have to download the indicator and import it into your Ninja. You have to be careful to restart your Ninja, because it's often needed, and then you can test it freely for between 20 and 35 days. In this presentation, I will be using NinjaTrader 8 because to the difference of NinjaTrader 7, it has integrated BDASK recording abilities, so there's no need anymore to record all the BDASK data by letting your NinjaTrader 7 run, like it was necessary with the NinjaTrader 7 and in using the GOM recorder stuff. So you had to keep your Ninja running, your computer running, your feed running, to be able to record all the historical data for the BDASK. And this is now not necessary in NinjaTrader 8. Of course, in Sierra charts, you don't have the historical data is present already since a long time, so there's no issue with the Sierra charts. You have all the backfills and all the old BDASK information that you need to build your delta and your order flow charts. So I would like also to mention that in all the slides that I'm going to present to you, this is only my own opinion from what I see using the order flow. I'm pretty sure there are lots of books, there are lots of YouTube presentations that will manipulate concepts differently and talk about initiative buying and responsive selling, etc. So I won't be using these kinds of terms, but I just want to point out that this is my own opinion about the tools. It is not that's all. Okay. So a little slide on the topics that will be covered. So we will start by analyzing and defining what we call buyers and sellers. Then there will be a little topic on the delta and all the associated stuff, which is the cumulative delta and the COT, the COT, and the delta finish. And then I want to show you a couple of order flow charts where we can identify setups and define imbalances and find setups, watch what happens on breakouts, identify support resistance zones, try to watch special setups that happen only on some instruments, etc. So a little view of all the stuff that you can see using the order flow ladder and the different settings and the different parts of the tool. And I'll end up with a little topic on automation. Okay, so let's start with buyers and sellers. So I'm showing here a chart of the DOM, the Sierra DOM for the CL contract. So we can see that here we have the ask. So yes, I'm going to try using a pen. Find it fun. So here are the sellers from the liquidity providers, which are either the market makers or the banks or the limit orders. Here we have the bid. So this is the buyers, okay? And typically what we see is that sellers, they're not ready to sell you a CL contract below 47.88. So that is the best price that they will sell it to you, not below. And the buyers, in no way, so I will have to change colors here because we can't see anything. So here, this is the best price for the sellers, and this is the best price for the buyers. Okay, they won't buy you anything above 47.87. So when the market stays like this, well, it's in sort of a balance or equilibrium, and well, nothing happens. So for a trade to happen, what needs to be done is that someone, an aggressive seller or an aggressive buyer, it needs to cross the spread. So if you want to buy, you have to cross the best buy spread here, and you need to buy at 88. This will make you an aggressive buyer, okay? And if you want to sell, you are going to have to cross the spread on the other side, and you will have to buy this at 47.87. and this will make you a seller. Okay, an aggressive seller. So this is how trades are made, and this is how the market is able to establish the prices. So what we see that is if you buy here 47.88 here, the person here that is buying, that is selling you a contract, one of the 24 here, he's not expecting to lose money. He's your counterparty. And here, if you sell at 47.87, one of the 48 contracts here, the one who's selling it to you, he's not willing to lose any money. So we see that in the market, there are two directions. There are buyers and there are sellers, but there are also two kinds of market participants. So there are the people managing the liquidity pools, which manage the limit and the resting orders, and they are the aggressive buying and selling traders. So what we want to be able to do using the order flow tools is we want to be able to identify from these populations who has the best probabilities to be winning on the next couple of bars, so we can make trades. So we have to find out if it's the buyers or the sellers, and if it's the aggressive, but if it's the aggressive traders or the liquidity providers. So if, for instance, if it's the aggressive buyers and sellers that are actually that are winning in the moment, so we are going to see, for instance, suppose it's buying, we will see the market getting up. So the buyers, they bring the market up and up and up to a point where we will see that there still is aggressive buying, but the price is not moving up anymore. It starts stalling here and even starts getting down. So when this happens, this means that all the aggressive buying that is happening, so people are committing trades and wanting to push the prices up. So all this buying, it's getting absorbed. It's getting absorbed by the liquidity providers, and the price is not moving anymore. So when this happens, what we'll see often is a reversal. Okay, so the liquidity providers, they're absorbing all the aggressive orders, and they think they're getting prepared to run the market in the other direction. So we have to be able to see all these kinds of phenomena. Is the market, is it the buyers or sellers in control, and is it the aggressive buyers that are in control, so making trends, or is it the liquidity providers that are absorbing the volume and preparing a reversal? So this is this is what we are willing to see and trying to detect from what we see in the order flow charts. So a couple of information about the data feeds. So and the different instruments that you can use. The data feed, it must be able to provide the bid and best ask. So that's what. Okay. We're back. Okay. So the data feed must be able to provide best bid, best ask. So that's level 1 data. So most data feeds, they provide this data, CQG, Arithmic, bar chart, e-signal, everything. They provide all this data correctly. The only provider that I know of that is not able to provide this kind of data, it's typically Interactive Brokers, IB, because it's snapshotted. So you don't have every tick. You have only one tick every 200 milliseconds or less. So you never know which was the best bid or best ask at the moment of the trade. So if you're using Interactive Brokers, you will need to use another kind of a data feed. What we also need to be able to show the charts is we need some actual volume existing, that makes sense, that would be provided by an exchange or some centralized organization that is able to measure the volume that is traded on the underlying. Okay, so this you have it when you are trading the futures. So you have the futures exchanges that centralizes all the volume and it's able to show to all the market participants where is the traded volume. But you don't have this on the Forex, for instance, because the Forex, there are lots of Forex providers, banks, they do Forex between them over the counter. So and there is no central exchange that will centralize all the volume. And it's the same for the CFDs. If you trade with CFDs, if you're in Europe, for instance, there is no centralized organization that is going to give you a volume that is linked to some kind of underlying. So the volume that you get is not a real volume information. So in this case, what you can do is watch the futures. So if you trade the Forex, you can watch all the 6X futures, so 6A, 6J, etc. And if you trade the CFDs, well, you can watch the underlying futures. So be it ES or YM or DAX or any kind of instrument that you trade on the CFD, it's most likely to have some kind of future that you can watch. In any case, if you use NinjaTrader 7, you probably won't be able to have a lot of a backfill and history of data with bid-ask information that you can use to build your charts because you have to keep your computer running. So you will probably have lots of gaps. What you can do in this case is use the up-down tick instead of bid-ask method to calculate the delta as a proxy. So typically this is what we use when we don't have bid-ask information. So what we do is when there's an uptick, we consider it a buy, and we consider that all the trading that is done after that at the same price, they're still buys. And when there's a downtick, it's a sell, and all the volume that's traded at the same price is also a sell. Okay, so this, I'm showing you here a view of when we can compare the bid-ask against the up-down tick. So you see that there are lots they have lots of things in common. So like here, we have an imbalance here that we have here. We have imbalances here that we have here, and we have imbalance here that we have here. Okay. But there are also lots of stuff that we don't have. So we have imbalance here that we don't find here, and we have imbalance here that we don't find here. Okay, so the most parts they are like, but there are some differences, and the biggest difference is that on the bid-ask part we see unfinished auctions. So unfinished auctions, they're happen at the extremities of the bars when we don't have one of the two sides at zero. Okay, so this is an unfinished auction, and here we see it's finished, and here it's unfinished, and here it's finished. Okay, because unfinished auctions, they cannot happen on up-down tick. By construction, they cannot happen. So this is why we have a couple of differences between the two charts. So you can see that they're close, but they're not exactly the same. So that's why it's better to have the real bid-ask. Okay. So I'm going to check if you have maybe a few questions. Let me check.
Let's see. There's a question on, can you get volume with up-down tick?
Yes, of course. With up-down tick, you have exactly the same volume. Let me check here. The volume is always okay. See, you have 59. Damn pin. Yeah, here the volume here is always correct. The 70 here that you have here, you have 70 here. The volume will always be okay. It's the delta that is different, but the volume will always be okay.
Okay. When When should you use up-down tick? Is it more relevant to the data feed?
Yeah, you should use up-down tick only if you don't have bid ask, and so that means if you're using a NinjaTerra 7, because if you're using NinjaTerra 8 or Sierra, you have the bid ask information. So this is the kind of setup that is only a proxy, so it's not the real value. It's not the real value. So it's always best to use bid ask. So I think that the only case that you would need to use up-down tick is if you're still on 97, because in all the other cases, the bid ask information, you have it.
Okay. How can you know that you're getting true bid ask information?
Well, most data feeds, they give you bid ask, the real bid ask information. They don't all give you the level 2. So I'll show you level. So what you need is level 1. Level 1 is the best bid ask. So it's this number here, and no, it's this price here and this price here. So you always have this number. Okay. If you have more expensive feeds, they will give you the 4 level 2. So the level 2, it's this, all these prices here, okay, and all these prices here. So this is level 2 data, so you have to pay more to have this kind of data. But the best buy price and the best sell price, you always have it.
Okay. On the one chart that you had, he says the first bar of the down tick seems to have unfinished auction.
Yeah, this is because it's the first bar actually. Okay, this is the first bar that was constructed, so this is because it has one, but it's only because it's the first bar of the chart. Okay, but it shouldn't have one.
Okay, that looks like all the questions, so I guess we can move forward.
Okay, moving forward. So now we're going to say a couple of words on the delta. So let me change color because I like changing color. Okay, so suppose that, so the delta is the accumulation of buys minus sells. So suppose that on a bar, we start the bar at 0. So on the beginning of the bar, suppose we start at 0, and then we have three buys, 2 sells, 1 buy, 2 sells. So the delta would be 3 minus 2 plus 1 minus 2. So this is the delta. Okay, so it's the buy volume minus the sell volume. Okay, so this delta, either we start each new candle at 0, we accumulate the delta on all the building of the bar, so we will have a closing delta, high and low delta for the bar, and we start again on the new bar at 0. So this is, you have delta bars, or we choose to continue to accumulate the delta bar after bar. So we accumulate the delta for the first bar, and then we continue with the last value on the next bar, etc. And this is how we construct the cumulative delta. So typically a delta chart with only delta bars, you have only little candles here like this, which are the delta of your bars, of the price bars, okay? And on the cumulative delta, you will see the delta that moves up and down like price, because we don't reset it on each bar. We continue to accumulate all the buys and all the sells bar after bar. So we can reset it. We can reset it on the beginning of a new session. We can reset it on the beginning of a new week, or we can never reset it. It's dependent of the choice. But it's the difference between the delta bars bar by bar and the cumulative delta. It's that the cumulative delta, you accumulate the delta from all the bars that are happening, and you reset it when you want. So the cumulative delta and the delta, they give you an idea of the flow. They give you an idea actually what is what the aggressive selling, or what the aggressive sellers or buyers are. You see where the selling is and where the aggressive buying and selling are. I'm going to show you on the next slide the cumulative delta. So when I started studying the delta, there were people that were doing a lot of charts using a cumulative delta, and they would analyze. So here we have the price, and here we have the delta. Okay, so the delta is the delta V3. Thank you, Sim22. And the people that were analyzing the delta, they would do lots of analysis and do lots of divergences and see divergences between here and here, and between here and here, and double tops here and here, and do lots of analysis like this, and divergence between here and here, you see. So, and when there was a double top on the delta, they call it inventory grab, and they were supposed to bring the market in the other direction. So I studied this. This kind of study. This was the initial study that made me build the GUM recorder and all the GUM stuff and GUM CD. But I was never really able to use it. I was never really able to find an edge using it, and I don't show the cumulative delta on my charts. But I'm very sure that there are lots of ways to use it and to be profitable with it. But personally, I didn't find any method that I was able to use correctly. Okay, but you see, you have two kinds of charts. It really looks like a price, and I'm pretty sure that you can make some different correlations between the price and the delta. But I must say that I was never able to use this as any kind of valuable information. But I think one of the values that you can find in the delta is when you see some failing aggressive buying or selling. So typically, this is it shows a chart here, and I circled a couple of bars, but this is what you see here. So we see selling here. We see selling here, but here the price is not moving down, and actually there's a big green bar here that's making a breakout over here. So this is a failed selling effort here. Okay, so these kind of failures, I find them interesting, because in all the analysis that you can do with the delta and this kind of analysis, I think that the failing, the aggressive failing, these are the most interesting setups, because it means that there are lots of people trying to do something aggressively, and it's getting absorbed, and it's getting prepared to fail. And the market is preparing to go on the other side, either direction. So you have the same here, selling, and candles are closing green, and here we have a higher high candle, okay? And the same here, selling, market, no, I'm not on the good. Okay, selling here, market going up. Same here, buying, here big red candle, and lower low here, and market goes down. And same here, buying, red candle, lower low, market goes down. So these are the most interesting setups, in my opinion, of what we can use with basic delta candles. It's really the failed efforts of the aggressive buyers of sellers, and their failed efforts means that all the orders that they're taking are getting absorbed by liquidity providers, and the market usually it runs a couple of ticks at least in the other direction. Okay, now I'd like a couple of words on the cut and the delta finish, because I usually get a lot of questions on these matters and what they are and how they're calculated, etc. So the up and down cut, it's the delta since the last price, since last time the price touched its bar maximum or minimum. Okay, so for instance, let's draw the price. So the price it goes up and down and up and up and down and closes here. Okay, so when the price makes a new high, we start recording the delta. for the high cut. Okay, here we see it makes the same high here, so we reset the delta and start counting the delta again from this point. Okay, then it goes down. Here is the low of the bar, and now we have the low, and then the close. So the high cut, it will be the delta between the high of the bar and the close. So it will be this, the delta between this point and this point, high cut. Okay, and the delta on the other side, the low cut here, it will be the delta between the low of the bar and the delta at the close of the bar. So this is the COT. So it's a terminology that is different from what there's another meaning from COT, which is the commitment of traders, but it's the outstanding size of the futures contracts. So in this case, it's completely different. It just means the delta on either side from either the high of the bar and the low of the bar. Okay. Delta finish is a little different. Delta finish, it uses only the delta in the bar. So let's suppose the delta in the bar, it goes here like this. It goes up, okay, and then it goes down and finishes here. So the delta finish is the delta between the last time that the delta touches its maximum or minimum and the close. So here it touched the minimum last, okay? So the finish is here, between the minimum and the close. Okay, so now we're going to draw the other way around. What happens if it starts to first touch the minimum and then touch the maximum and then close like here? So then in this case, it touched the maximum last, and the finish, it will be this. Okay, this is delta finish. So there are different concepts. With the delta finish, we use the maximum and minimum of the delta, and with the COT, we use the maximum and minimum of the price. It's the price here that is drawn, and we calculate the delta on the maximum, the delta on the minimum, and the delta at the close. So I'm going to show you this on another kind of chart because it will be easier to see. So with the green and red bars, I have a 15 minutes CL, and all the small bars, there are a 1 minute CL. Okay, so we can split the big 15-minute bars in small bars and see what's really happening inside the bar. So for instance, here on this bar, prices goes up, then it goes down, up, and closes here. Okay, so the top of this bar is here, and the bottom of this bar is here. Okay, so now let's see what it's doing with the delta. So the top here, it's around here on the delta chart, and the bottom is probably arriving somewhere here on the delta chart, and the close of the delta is here. Okay, so the low cut is here, and it will be shown in a little box here, and the high cut is here. Okay, it will be shown here. Okay, so usually the high cut is negative because it's all the delta energy that's needed to take the price down between the maximum and the close, and the low cut, it's a positive because it's all the delta energy that's taken to move the price from the low of the bar to the close of the bar. Okay, so let's draw a little with the finish. So here, for instance, with the finish, the delta here is going up and down and up and down and up. Okay, so the last time it touched either its maximum or minimum, it's the minimum. So the finish is here. Okay, it's positive. And let's see an example on the other direction. For instance, here it goes up, it goes up and down. So the last time it's touched its maximum or minimum, it's the maximum here. Okay, so the delta finish is here. Okay, F. So this is the difference between the finish and the cut. So when using the cut, we look when the prices touches his maximum and minimum, and we map the corresponding deltas and show and these are the correction for the cuts. And with the finish, we only use the delta. It's the maximum of the delta and the minimum of the delta that are used, and we check when if it last touches the bottom or the top. Okay. So I'm going to give you just a few examples, and then I'll answer some questions. Delta finish, it can be used to show trap counter trend traders on established trends. So here you see an example of a 5-range ES, and I only plotted the finish. And what you can see is when it goes up, we have all these negative numbers here, and it goes up. Okay. And then we see positive numbers here and it goes down. And then we see negative numbers again here and it goes up again. Okay, so it seems kind of counterintuitive to see all these negative deltas and prices moving up. And we have the same on the other slide, which we have negative numbers, prices going up, and here we have all these positive numbers, prices going down, and then again all these negative numbers and prices running up. Okay, so in order to try to explain this kind of phenomenon, I plotted another kind of chart like the other one that was used. So we have, with the big bars, we have 3 minutes, okay, and the small bars, they're 30 seconds, okay. And what we see here is that this minus 118 is the finish of the people selling the top here, okay. And here the finish is the people selling the top here. And here the finish is the people selling the top here, okay? And etc., etc. And here the finish is the people selling the top here. So what's actually happening? Well, all these people, they're trying to sell the top. They're trying to top fish the market. So they keep doing aggressive orders, and they keep trying to bring the ES down, and they keep trying to sell it. But actually, it's a big established trends, and they're all going to get stopped out. So you see all this selling here, on the next bars it's stopped out, and here all the selling here it's stopped out on the next bars, and here all the selling it's stopped out on the next bars. Okay, so actually all these negative numbers, it's the people that are selling the top and that are starting to provide some volume when their stop are going to get hit when the market goes higher. Okay, and we have the same on the other side. So all these contracts here is the people buying the bottom, and all these contracts here, the people trying to buy the bottom here too. And this is not going to work either, because they're all going to get stopped too. They're going to get stopped and fuel the move. So all these contracts, they're actually showing the bottom fishers in this case that are getting stopped out and providing fuel for the move going down. Okay. And now the same kind of charts with the COT. So the COT, like the delta finish, it can be used to show trap traders and failing aggressive buying or selling. Let's see this kind of chart here. So here we see on the normal bars, we have negative delta on the top here, because here it's negative because it's all the delta that's needed to bring the price from the top of the bar to the close. The same here and the same here, okay? And on the other side, it's positive because the delta needed to bring the price here and here and here, okay? We have this kind of stuff, but we have one kind of strange value, it's here, minus 333. So what does this mean? It means that from this point, the bottom of the bar, there are 333 contracts that were sold to try to bring the market down, lower, probably trying to bring it back below this kind of level, trying to bring the price level lower, and it's not working. It's not working at all because the price, it's actually moved higher and it's making a higher high, okay? So this is the signal, kind of signal that the selling is failing. So it's again kind of it's a failed aggressive activity, and we see it's failing. So it gives a pretty good probability for the other the move in the other direction to win. Okay. And we have the same here. We have negative numbers here, positive numbers here, and suddenly you have here this. Okay, a big negative number of people trying to sell here, and it's not working. Prices are going up. Okay, so this gives you a pretty good high probability signal for the market to go higher. Same thing on the downtrend. So we have again all these normal buyers, sellers here. This is the delta energy to take all the bars down. And here we have a buyer. We have a buyer. We see that probably he's trying to bring the market over this kind of level, and it's not working. So from this point, they have bought 93 contracts, and the prices are getting lower. Okay. And here again, last slide, the same. So we have all these normal bars here, market going down, and here we have buyers that are trying to push the market over here. Okay, but it's not working, and the market is closing lower here and lower here. So it can give you a pretty good probability for a breakdown to be successful. Okay. So that pretty much ends up the delta stuff. Maybe you can answer a couple of questions if there are a couple of them.
Okay, let's see. Is there a relationship between cumulative data to open interest?
No, not at all.
Okay.
Sorry, I thought you were talking about cumulative delta and with the COT and open interest. I don't know.
Okay. The delta divergence that you were describing, where delta is red with a tail at the bottom but price is at a low and starts to increase. Does that work differently if volume-based bid-ask versus up-down tick? The reason I ask is absorption is, as I understand, mostly limit orders, and volume bid-ask is mostly market orders.
No. Really, the up-down tick and the bid-ask definitions, they're not really the market orders. They're not defined by bid-ask. If you have the bid-ask orders also, if you use the up-down tick, so I don't really see why they should be. I don't know. I don't know if I don't know.
Okay. How does delta finish always equal HCOT or LCOT?
No, it does not equal LCOT or they're really different stuff. So they don't equal each other. So they because they don't measure the same kind of stuff. But let me check something here. maybe sometimes maybe yes, seeing the construction, how they're constructed, maybe on most cases there can be some similarities between the finish can look like a low cut or a high cut on some occasions, but I think that most of the time they could be different. But there is stuff that are used on different maybe the same kind of numbers, but they're used in different contexts.
Okay. Does your CD product allow for filtering on trade size, e.g. large or small trades only?
The CD, the GOM CD on that was free on Big Mic, it does, and the CD with SIM22 does also. They both provide filtering.
Okay. What do you do for the finish calculation when there could be a top and a bottom finish on the same bar because the close equal open?
Well, when we calculate the finish, it doesn't matter. What we're looking at is the finish, is the delta here. You see, this is the delta. So the delta here that I'm drawing, even if it closes, let me use my red pen. So let's suppose it's opening at this price, and then it closes at this price. So we have the same price at the open and the close. It doesn't really matter because what we're measuring is the delta between the close, but also the maximum or the minimum. So unless they have a really flat delta, which is not possible because in the bar we always have buyers or sellers, we cannot have a null finish unless, which happens, we end on the top. For instance, if let me erase this, and erase everything. So let's say that the delta is here and here, and it closes here. So the last time the last thing that it touch between the top and the bottom is the top. So here we have a zero finish because it's closing on its maximum, and we also have we'll also have a zero finish if it closes on the minimum. But if it closes between the maximum and minimum, it's not null.
Okay. Which of your indicators show the COT and delta finish?
The order flow indicator.
Okay. Those stuck traders in your example aren't necessarily stuck. They could just be closing or covering successful trades and
that's
close
true.
exit. Okay.
That's true. That's true. But even if they're closing, they still provides liquidity for the move to continue in this direction.
Okay. Are these indicators available only through Gomicators.com?
Well, you still have available on NinjaTrader 7 the volume ladder for NT7, but it doesn't have the finish, for instance, and it doesn't have the imbalances. But for the imbalances, you can also use the Metro ladder, which is free for elite traders on futures.io. So some of the stuff you can find on for NT7 you can find on the futures.io on the elite section, but for NT NinjaTrader 8 and Sierra charts, it's only available on Gomicators.
Okay. What have you discovered in the terms of effectiveness or usefulness of the COT and the finish for trading?
Personally, trade the DAX, and the DAX is a very thin instrument. There's not a lot of volatility. There's not a lot of liquidity. And for the DAX, for instance, it doesn't react very well with the cuts and finishes and deltas. It's a very specific instrument. But what I do like to watch using the order flow with the DAX is the stop outs that you can, will show the setups later, but you can easily see some very specific DAX setups that appear using the order flow. So that is my my area that I use the order flow for. But that's it.
Okay. Are you going to show how to use some of these concepts in like actual trading?
With a real chart, no, I'm going to stay. I've prepared the slides, but no, I'm not going to run any kind of trading simulation. No.
Okay. Okay. In your opinion, does the delta finish work well on the ES?
I think that's yes. It's the instrument on a range chart that I found where it can work the best. But again, I'm not an ES trader. I'm a DAX trader, and this kind of concept did not work very well. So, like I will explain in the couple of next slides, is that every instrument, it has his own behavior, it has his own preferred kind of time frames, and it has his own kind of setups. So it's up to everybody to hunt for different kind of setups. I will show you a couple of setups that you can find on the DAX and on the GC, for instance, and that appear only on these kind of instruments. But and I'm not an ES or a CL trader, okay. But you have to identify your setups.
Okay, we'll make that the last question and move forward.
Okay. So now I'd like to show you a couple of examples using the order flow. Okay. So here is what we see on the basic order flow chart. So you can see that you're not able to with a normal human brain, you wouldn't be really able to find any very useful information. The only maybe information that you can find is here that there is sort of a buying breakout here with very thin volume in front of it. So on the volume ladder here, here we have the sells, and here we have the buys. Okay. So this is the real basic. But if you wanted only to plot the buys and sells on a ladder, this is what you would find, and you would see that it's not easy to trade. But it's not easy to trade or to find any kind of information because you can't really process it simply with a brain. On this chart, I added delta coloring. So here I replaced the sell and buys here by volume and delta. So you have the exact same information, but it's so here we have the sum of the buys and the sells, and here we have the difference between the buys and the sells. Okay, so it's the same information, but represented differently. So here we see that we have some. So we are able to grab a little more information. For instance, we can see some selling here. We can see that there are some selling here, people that are probably going to get trapped when the market is going up here. We more or less lost the information here of the breakout because we can see it anymore, and we see probably also here some trapped buyers here that are going to bet they get trapped when the prices go down. But it's still using only the delta information. It's not. We grab a little more the different powers that are running in the market, but it's not easy to make any sort of kind of decision. So we added another concept that is the imbalances to try to extract some more value. So we'll see what they are in the next couple of slides, and we measure actually the power of the buyers and the sellers on each auction. So here we are able to see that there is big buying here, making a breakout here. We see that there's a selling on this bar and bringing it down here. And then there is some kind of a hesitation here because we have no imbalances. And then there's some buying taking place and market goes up. And then it continues to goes up here with these imbalances here. And then there's some hesitation on this bar with no buyers and no sellers making really big commitments. And then we see some selling appearing here and market going down. And then it's going to make some hesitation here. But we can see that there is a very critical zone here because there's a lot of fight on it. Okay. So this is the charts that are more readable than if you only have the numbers or only the deltas. And because they bring some new information, which is the imbalances that show the struggle on each level of the price auction. And I'm going to explain the concept on the next couple of charts. So here we're going to bring back our our DOM chart from Sierra again. So here we're going to get interested at what's happening here between here and here. Okay, and this diagonal stuff here. So here the price is stuck, nothing is happening. Stuck between 88 and 87, nothing happens. And then suddenly we're going to see appearing some buys here at this price, and then sells at this price, and buys at this price, and sells at this price, and buys at this price. So this is the struggle that is happening on this price level between 88 and 87. What's happening? So we're going to count the buyer volume and compare it to the seller volume. So if there are more seller volume than buyer, we're going to compute the ratio of sellers divided by buyers. And if there are more buyers than sellers, we're going to compute buyers divided by sellers. Okay, and we're going to establish some kind of ratio. So by default we use a ratio of 3. And what we will say that if the ratio is under 3, well, the market is kind of balanced, so there's the same power between buyers and sellers. And if sellers divided by buyers or buyers divided by sellers is larger than 3, then we have an imbalance on this price level. And we're going to plot and color the numbers on the ladder accordingly, okay? And then the price is going to move. It's going to move. Suppose it's going to move down here. Okay, so we're going to have here the sellers and here the buyers, and they're going to fight on this price. And we're going to see what happens on this auction, and this auction, and this auction, and every auction between the buyers and the sellers on every price. Okay. So this can give you a much better information than what the delta can actually give you. So this gives you this kind of price here, this kind of chart, sorry. So we see all this selling imbalances here, the purple marks, market goes down. And then we see this hesitation here. There's no imbalance on either side, so this wouldn't be a good idea to short in this in these bars. And then there's a little fight here, and then there's buyers imbalances here appearing on the charts, and the price is going up. And so in this case, you can buy with more confidence. Okay. Those charts here. So market goes down on selling imbalances, then goes up. But here we have a very big selling imbalance, so it wouldn't be a very good idea to go long over here, even with this red candle, because actually it's going there's going to be more selling imbalances, and market is going to go a little down. And here there's going to be a little range here, and suddenly it's going to take over with all this buying here and go up. Okay. So it gives you some information that you cannot see about aggressive selling in certain zones, and that will prevent you from taking longs if you see a huge selling in front of you. Okay, even if there's a green candle. So imbalances, they can be used to gauge market sentiment approaching to a breakout level. So we're going to study two situations here. So and see what you can see on the order flow ladder when you're approaching breakout price. Okay. So for instance, here we are establishing a level here, and we're going to study what happens here. So we're going to fail 3 times to break out, and it's going to break out just after that. Okay, but we're going to see what we can see on the order flow. So here it's the first try. So we approach the market, but there's a selling imbalance here, and the market goes back. And second try, again, selling imbalance, market goes back. Third time, we start to see some buying here, but it's not able to sustain the movement up here. It goes back. And finally, we see that here we have imbalance here, imbalance here, and imbalance here. And then the market is free to go, and it's going to run much higher. Okay. So here we can see on the order flow the selling pressure when you are approaching the level. Okay. Another example here. So we are establishing a level here, and we're going to try to break it once here with the 3 tops here, and that's not going to work, obviously. And then it's on the fourth try, it's going to go through, and we're going to see what's happening on the order flow. So we approach once, and we have a selling imbalance. It goes down. We approach a second time. We have a buying here, but it's not sustained here, and we have nothing here, nothing here. Third time, we still have selling just before the level, and it rushes down. And on the fourth time, we can see that we have a buying imbalance here, and we go through it, and then immediately after this, we have buying here, and it rushes up. Okay, so you can see that from what you can see on the order flow, you can gauge the power that are appearing in front of you when the order flow is when breakout levels are approaching. And I want to show why it's a view that you cannot have using delta, because I'm going to show these exact charts with the delta coloring. Okay. So here you see green. You see green, so you think you have buying here, but this auction is actually lost to the sellers. And here you see green, but this auction is split. There's no one winning here. And this here you see green, but this auction is actually lost by the buyers and won by the sellers here. Okay, so this is why the price is going down. Even if you see actually green delta, the delta is green here because this number is larger than this number, and this number is larger than this number. Okay, but it's not taking in account the auction process. And when we continue to go up, so here this is the auction is 1, and here we have red. We have red here because this number is bigger than this number. But if you think in auction, this auction is won by the buyers. Okay, and this auction is also won by the buyers, and this auction is won by the buyers, and this auction is won by the buyers. Okay, so it gives you a different view from what you can see with the delta. Now we're going to show a couple of charts where we will see that consecutive imbalances, they create support resistance zones that are likely to be defended. So for instance here, we have 4 imbalances that follow each one another, they're consecutive, and it creates a support zone. Creates a support zone that is tested here, and then we have a buying imbalance here, and the market goes up. Okay, and again here we create a zone here that replaces this resistance that becomes support, and market goes up. Actually, this setup where there is a resistance zone that becomes a support zone, we will see it later, and it's a setup that has a high probability to gain a high momentum. Okay, but we see that this zone here, it worked here, it stopped the market. We had selling here, and this support zone here, it stopped the market here, and it ran up here. Okay. Another example, we have consecutive imbalances here. It's creating a support zone. Market goes up on positive imbalances. Then it comes back. It's tested here and here, and then we see again buying, and even making a new support zone here. That's tested here, and it goes up. Okay. Another chart on the other side. So here we build a support zone. Market goes up. Here we have a first try to go down, but actually there's a new candle here that appears, but that is not able to go through the support zone. And even here we see a lot of buyers that are trying to move the market up, but they're failing, and the bar is closing much lower here. So this is absorption, and it goes down. So this is an effort that is not working. Failed buying effort. Okay. Imbalances so can be used to detect absorption, so which is a failed aggressive buying selling. So one example here, so we have a imbalance here, imbalance here on the selling side, and we see that what they're actually doing is they're building wicks. So market goes up and down and up immediately, and here the same thing, down and up immediately. So these imbalances here, they're not able to move the market lower. And on the next candle, we start to see in this same zone, now we see positive imbalance here. So all the selling is getting replaced by buying, okay? And now it's going up. So all these orders here, they're getting absorbed actually, and the market reverses. And the same on the other side. So we see here positive imbalance that's on a wick, then the candle closes below it, and we have another one here. It makes very a higher high and builds a wick, and market closes below it. Okay, and now we see on the same level here, on the same level here. Now we see selling here, okay, and selling here. So now it's able to go down. So this aggressive, this buying, it's being absorbed. Okay, I'm going to erase this because it's not nice. This buying here is getting absorbed, and the market is going down. Okay, last example here, we have a very big selling imbalance here on a wick. The market makes a lower low and builds a sort of a doji here, and then there we see buying on this zone. Okay, so the buying here is being absorbed, and the market is going up. So this is absorption again. This selling here, it didn't manage to bring the market lower. A couple of charts on, so this is what I mentioned earlier, is that when using the order flow, you'll see that each instrument, it has its own kind of a feel. Each one, you can build different charts that will look better on using different time frame or range chart or time-based chart, etc. So it's you really have to do some research efforts to be able to see what kind of settings the instrument that you are trading responds to the best. So I wanted on the next couple of slides to show a couple of settings that can happen on GC or the DAX, and that will only happen on GC and the DAX, and it will never happen on, well, I didn't see them happen on the ES and CL, for instance, because these markets are much more liquid. So this is what I call the GC surge. So you will see this on GC. So it makes a huge move up, making a big imbalance here with zeros or very single digits prints here. So it's just running through the liquidity here. So what it does, it makes a move through it like this and then goes up again. Okay, so it's certain up. Another example on the downside, a surge here with single prints here, down and continuation. You'll never see on the CL chart or very rarely on CL charts or on ES charts zeros here or ones. Maybe ones, but zeros never. Okay. So surge and down. Another example up. You see here, perfect example, big surge, zeros up, surge and up. So this is the kind of charts that you will only see on GC. On the DAX, we can use the order flow to watch for stop outs or reversals. For instance, here on the DAX, what it will do that again we won't see this on CL is on the very extremity of a bar, it makes big imbalance here and zeros in front. Okay, and then it runs down. So here it's an example here where it's not happening. So we don't have the imbalances here. We don't have the zeros here. So this is a normal kind of candle. So it goes up, it goes down, and it goes up back again. It's not really a stop out. It's not a stop run. Okay. And then here another example of the stop out of the stop run. So here the imbalance, here all the zeros, and the market goes down. Okay. So these are the setups that you will see, that you can see. This shows that you can identify some very specific setups on specific instruments that you are, and that you need to hunt for them. This is, so you have to develop some kind of feel for the instrument. Okay. So maybe I can answer a couple of questions on imbalances.
Okay, 1 second. Can you explain how you are defining an imbalance again?
Yeah, sure. So let me go back to my chart. Basically, if you look at this chart, this basic chart, so let me erase. So I look at this auction, for instance, with these prices, and we use a default ratio of 3. So when this number is 3 times higher than this number, it's a buy imbalance. Okay, and when this number is at least 3 times higher than this number, it's a sell imbalance. Okay, so we put diagonal comparison here, and we compare if this number, if 3 times or more bigger than this number, or if this number is 3 times higher, bigger than this number. Okay, and when this happens, we have a buyer or seller imbalance.
Okay. Let's see. Is there a minimum number of consecutive imbalances that you use to identify support and resistance?
Yeah, in the indicator, it's set at 3, but you can use other kind of criteria. You can use, so it's set at 3. So from 3 you have a zone, and you can also set up a minimum volume here. And so you want to see a zone here with, for instance, a minimum of 200 contracts or whatever. So you can gouge you can put some weight on this to force some kind of size on this support.
Okay. Is the imbalance on bid-ask data?
Yes, of course.
Okay. Do you consider a minimum bid or ask size for each individual imbalance?
You can set an individual size on the imbalance too. Yes, in the in the settings. So I don't use one, but you can use one in the settings. You can say that I want an imbalance with a minimum 100 contracts.
Okay. Do the supply and demand zones print automatically on the chart?
Yes.
Okay.
So I just want to add something here, is that they plot automatically. So here on my examples, I set them up to be reset on every session, because I found out that usually at the end of the session there were not too much valid on the next session, and also that there are different kind of settings to define when they disappear. So it can be when the POC, when the maximum volume crosses over them. It can be when the full candle crosses over them. There are different settings to define when is your zone invalidated. Okay, there are different settings.
Okay. Let's see. For the imbalance, what if the denominator is 0 or very low?
If the denominator is 0, then I think that we always have an imbalance, like here. You see, this is 0, so we have an imbalance.
Okay. Are unfinished auctions tradable? How do you use this information?
I'll show you. There's a slide on unfinished auctions at the end of the slides.
Okay. The support and resistance levels, they're part of the indicator. There's a couple questions about that. Okay.
Yes, they're part of the indicators. They're automatically plotted, and they disappear automatically, and they're part of the indicator.
Sorry, I had a question. People keep typing, and I'm losing it. Let's see. Do you use this in conjunction with the profile, or just this one by itself?
I usually have a profile, yes, so it's used in conjunction, but can be used without it. Because it's like everything in trading. What you're looking for in trading is it's always confluence of different information. You want confluence from the zones. You want confluence from the volumes. You want different kinds of confusion, even from moving average if you want. So the zones here, they bring you confluence from bid-ask and the and imbalances in the market flow, and if you in this information you need to confirm it and to have confidence with other kind of indicators if you want to have confidence in the trades, because nothing will work on all setups every time. It's just not going to happen. You need to put all this in perspective.
Okay. Do you provide the chart settings tailored for each market based on your observations?
No, sorry, I don't provide this.
Okay. Do you provide any training on how to use your indicators?
Unfortunately, I have I have documentation that will describe all the settings, and for now I don't really have any training information. I guess that the training, most of the training, maybe well, I'm going to use this this video as a start of a training videos. But I know that there are a lot of people that are asking for training, and I see what I can do on this matter.
Okay. Does hesitation usually indicate a reversal in price action?
Not always, but it not always, but it what it does it makes you wait. It makes you wait for a better setup. If you see that you don't have any either buying imbalance, selling balance, kind of arranging stuff, you know that now it's time to wait until you see some decent action from one of either the two sides. So when you see hesitation and no imbalance showing up, it means that the good idea is to wait. Because even reversals they're created by imbalances that are getting absorbed. So even for a good reversal, you need some kind of a big imbalance to show up and be absorbed. If a market is just hesitating, it's better to just step out.
Okay. Which bar type apply? Okay, let's see. What is the best bar type to use for these indicators?
Well, I like for this kind of indicators, I like two bar types: range bars and minute bars. Well, maybe 3-5 minutes and maybe 4-5 ranges. I think they provide good charts.
Okay. How did you learn about Delta? Were you a trader or a programmer for a trader?
No. For the data stuff, I learned all this in 2008 on trading forums. It was hot stuff at the time, and there were lots of information on this, and people were trying to do stuff. I think the main platform the market data, it already existed, and I think that Investor RT had some stuff too. At that time, it was a lot of people were talking about it, and I had to build my own framework to be able to do it with my Ninja Trader.
Okay. And I'm gonna make this the last question, and then we'll keep moving forward. Why do you use the default value of 3 for the imbalance on the chart?
No specific reason. I started using 3 because on other tools, for instance, on the Metro ladder, it started at 3. I thought it was getting good charts, but no, I cannot say that I tried all the values and to see which would be a good value. But it's a setting, so it can be tweaked by users to your liking. But I think that the default value of 3 gives pretty good values.
Okay.
Okay. So now I would like to do a couple of charts on absorption, and if we can detect absorption. No, see, we did that already. These two we did already. Okay, so I would like to do a couple of slides on reversal signals. Okay, so what we want to do if we want to detect some kind of reversal is suppose that the market is downtrending, so we are getting down candles, and the market is going down. So if you want to spot a reversal, what do we would like to see? If to have some kind of probability to have a reversal, we would like to see a fading interest in selling. So here people getting less and less interested in selling the market. So decreasing volumes here. We would like to see some kind of imbalance on the other side with a big volume. And we would like to see all this in some kind of high volume zone. So all this is going to provide trapped traders that will be able to fuel the move up. So this is one kind of setting that we can try to look for, because the premises, they do make sense. See, decreasing volume, decreasing selling volume, a big imbalance on the other side, and some kind of volume cluster that where people are going to get stop outs and will propel the move on the other side. So for instance, they can be detected here. So on this chart, we see a big move down. And then here, there's huge volume here. So this is something like 10,000 contracts here. We have decreasing activity on the selling side here. And we have an imbalance here, okay? And then we see some buying here, and it goes up. So this is a typical case of a sort of a of a reversal, and we have nearly the same here. So market goes down. We have big volumes here too, maybe 6,000 contracts, and we have decreasing interest here, and we have an imbalance here, and we have an imbalance here, and the market goes up. Okay. So you must be very wary with this kind of. So this is an indicator that is included in the order flow. It's the reversal indicator. It gives you clues, but you really need to put this in perspective, okay? And there's an example here on the other side. So market goes up, then there's kind of a hesitation here with no imbalances anywhere, and then we see a decreasing interest in buying and a selling imbalance, and we start to see selling here, and it goes down, okay? So it gives you clues, it gives you hints. But this kind of signal, you really need to have confluence with other kind of settings, of setups. Okay, but all this, it's plotted directly by the indicator. Okay. So like I said, not every signal will work, and you need to sort of combine signals to increase your probabilities. Because if obviously, if only a signal with an arrow here, it would work in every case. It would be programmed by the first bank coming out and getting arbitrage in a couple of seconds. Okay, so it's not. You see in here, it's a case where it works nicely, but you need to do your own combination with your signals. Everything is trading is really a matter of confluence. Okay, so here we're going to pair a couple of signals to increase our probabilities. So for instance, here we combine the reversal arrows with the SR levels. So here you see that we have a big resistance zone here created by imbalances, and then we have some reversal arrows here. So we're not going to take them. It makes no sense to take them in front of this resistance zone, okay? But here, on this side, this one, it's rejecting the resistance. Here, with this follow through, and here a follow through. So in this case, it's better to take those two, okay? This one, I wouldn't take it because we're actually on the green bar, okay? Same here. We have a buying zone here, support zone. We have selling arrows here, but we're not going to sell into support. It wouldn't be a very good choice. Eventually, it did work, but it's not something we'd like to do. Here, it's the better idea. You have a resistance zone created here, and then you have the arrows here. So it gives you confidence to take the trade, and to take the trade here too. When the move is stopped out, it reverses on the resistance and the move goes down. Okay. And another one here. We have a resistance. We have a up reversal bar, but we're not going to buy into this resistance zone. Okay. Here it's better, but it's we're not sure that it's going to work because we're really on the top of the bar. This one would be better. We have a red candle. The market is going down. It reversed on the resistance line. Okay. Another one using the COTs. So we have all these negative COTs that are in the normal numbers, and here we create a resistance line, and here we have our positive number. Okay. So this means that there are people that are trying to take the price up here and that are failing, and we are in the middle of the resistance zone. So this can be a good trade setup. Okay. Or the same on the other side. We create a support zone, and here we have the negative numbers where we should have a positive numbers. So this means that there are people that are selling here and they're not able to bring the price into the support zone. Okay. So this gives you also a good opportunity maybe to go long if you find confluence maybe also with other kind of indicators. This is the last one, I think. So here we create a zone here. We have a negative number here. Market goes up. And here we enter into the resistance zone here, and we have this positive number. Okay. And market goes down. So this we can see the confluence between support resistance zones and the COT values. So we mix them up, and when we have signals on both of them, it gives us a better probability for a trade, even if in this case maybe it would be a good idea to not try to take it long into this zone here. Okay. Another view on longer time frames that you can see on the indicator is that you are able to shrink your chart and to have a really a long-term view on the difference on the different support and the resistance areas. So here you see that we create the support, it's tested here and gets blasted here, and then we create another support here, it's tested here, it's tested again here and blasted here. And now there's a big down move when we keep creating resistance zones. Look at this one, tested here, tested here, tested here, and then on the breakout here down, we create another one that tested here and here and here, etc. And here we create a buying zone that we test here, and finally smashed here, and etc. So you can see the zones on a higher time frame. Okay, so you don't have to trade only on the very small the big candlesticks where you can see only a couple of bars. You can also shrink your chart and see all the all the zones on on longer time frames, and they will show support and resistance zones that maybe you wouldn't see if you just draw them by hand. You see, so here you would probably have zones here, okay, but this one and this one and this one you wouldn't be able probably to draw them. Okay, so there are there are resistance zones that appear purely from the imbalances of the buying and the selling around these prices. Another setup I would like to show that often that arrives quite often and provides usually some kind of a big momentum is when we have supporting zones becoming resistance zones and the other side round, so our resistance zones become support zones. So an example here, we have a resistance zone created here, and when price comes back into the zone and go through it, actually it builds a support zone here. No, this is support, sorry. And while it's doing this, it gains some momentum, and it does a big move down when transforming the support into resistance. Okay. Another example here, we have support. Market goes up, down, and on the down move, it's going to destroy this support and to build a resistance here, and it has a big momentum here to go down. Okay. Another one here, we create a support, market moves up, and while going down, creates a resistance here with big momentum. Okay, and the same here, we create a resistance here, becomes support, but we have a big momentum, and maybe we can even consider this one, big momentum. Okay, so when imbalance zones, resistance or support, change sides, usually it's done with a big momentum. Okay, so I don't really know why this happens. Maybe because there's lots of stops involved or things like this, but it does happen. A little slide on unfinished auctions. So unfinished auctions, it comes from sort of auction theory, and it happens when there is no capitulation of one side as the top or bottom in the auction process. The idea is if it's revisited a couple of bars later and the auction is finished, then it can provide a reversal signal. So for instance here, this is a finished auction. The last auction that happened here was here. Here we had the buyers, sellers. Here we had buyers, okay? And they fight it for this price. So this is the last auction that was fought and it's completed. Here, the auction is not completed because we don't have zero on one side. For the auction to be completed, we need to have zeros here on the downside, and we need to have zeros here on the upside. So here, you can see that the auction here is not completed. So the idea of the setup, though it's quite rare, and it happens mainly on minute charts. You have an unfinished auction. On the next couple of bars, it's finished. Then if you have some kind of other signals like here, the positive imbalance, you have a probability of a reversal here. Another example here, unfinished auction here. And the next bar, we have a retest here, and the auction is finished, and market goes down. Another one here, unfinished, auction, finished, market goes down. Okay. So it's really a setup that occurs quite rarely actually, and I don't trade it, but I know that people use it. Another example here, unfinished auction here, auction is finished here, with a zero here, and market goes down. Okay. Last slide for the setups, it will be on the point of control. So the idea of the point of control, it comes from volume, from market profile actually. So the idea is that if on the preceding bar we have the price here, this is the price, and this is the volume. So the idea is the point of control is the price that has the biggest volume here. Okay. So this is the POC, point of control. So the theories behind the volume profile and market profile, they tell us that the POC it acts like some kind of a tractor reverser, so price is often rejected. It's often tested and rejected when you test previous previous values of the point of control. So I find it most useful on longer time frames, like on hourly and daily charts. I'll show you what it looks like. It looks like here. So so when here we have the previous point of control. Here is what we call the naked point of control, naked POC. Naked means that it's not touched, okay? So here it's touched and it disappears. And here the same, we have a naked POC here and disappears here. So, but you can see that here, this POC here, it stopped the value area here. And this one stopped the bar here. And this one stopped the value area here and the bar here. And this one stops the bar here. And this one stops the bar here, okay? So a lot of people, they watch the previous previous days, previous hours point of control. So maybe it's not, maybe you can't really trade it, I think, maybe as a signal entry. You see, just trade the reversal on the touch of the POC. But if you see it in front of you, maybe it's a good idea to exit the trade, because other people are monitoring and it can reverse on these kind of points. So this chart is also included in the order flow indicators. All these charts are the same indicator. So you can zoom the charts, shrink them or make it larger and see different kinds of information. Okay. Another example here, the price here, it stops the value area here. And this one stops the price here, stops the price here, stops the price more or less here. And here, this one, it stops the price here, okay? So that's the kind of idea of trading with the previous points of control, okay? Maybe now I can answer a few questions.
Okay, let's see. Does it print the box when the imbalance happens?
The box, and not sure I understand what you mean by the box, but everything is like that appears here is plotted it appears in real time, so it does plot the imbalances, and it plots the yes, if what you mean is the support and resistance area here, these areas here, yes, they're plotted by the indicator.
Okay.
It's all automatic.
Is there any significance to the width of the support and resistance bands?
I would say, personally, no, I don't see differences. Whatever the thickness is, I consider it as a support or resistance. You can you can ponderate. Well, you can choose to only have support or resistance bands from a certain size in imbalance. So you can set them to be quite thick in the number of contracts. So the idea is that you have, even if it's thin or thick, quite a big number of contracts here that were motivated at one time to push the price in one direction, whatever the size, whatever the thickness.
Okay. I'm going to make this the last question because we've already ran over on time.
Okay.
How reliable are the imbalance support and resistance zones compared to price points and swing points on a regular chart?
Well, they're really different ideas. They're really different. I think they're really different. They provide different signals. You can't really compare them. They're really based on the order flow. So they give you, they will show you levels at levels that will work, that won't appear on using pivots. Okay, so they're there are some that will be common, it will be the same, but there are also some that won't be the same at all, and they work also. So it's let's say they're complementary.
Okay.
Okay. So I'm going to run through the last slide. So automation and strategies. So unfortunately, the current implementation of the order flow indicator, it does not support automation, but I'm working on it at the moment, and I'm going to expose most of the maximum data available using plots, so it can be run through strategies and Bloodhound. And the candle data, it will be exposed too, but it will require a little more work to make it to be able to use it, because you will need to write code in C# to go through the candle price levels. But the other kind of data, like the delta finishes and the COTs and also the imbalances levels, you will be able to access them using automation. Okay, so it should be available. I'm trying to do this for June, so you can subscribe to the newsletter on Gomicators if you want to be notified when it's available. If you're already a subscriber, you will get directly the notification in your indicator, because they tell you if there's anything new. So thank you a lot to everyone for your time, and you can contact me at gomi@gomicators.com or use gomi@futures.io. So I hope that you learned a couple of stuff on order flow reading, and hope you had a good moment. And I'd like to thank you all very much.
Absolutely, thank you. If I missed or was unable to ask a question, please email Gomi directly, and he can help take care of you. I also ask that you post on the forum. If you have a question that you think others might, benefit from, post it on the forum and tag Gomi, and that way we can all benefit from the question. As always, thank you for the information, the webinar, and most importantly, your time, Gomi.
Thank you very much to you, Terry, and thank you to to Mike for providing me with this webinar.
Absolutely, thank you.
Okay.
Bye.
Goodbye. Thanks.